Hi, I'm Laurence Parker-Brown. Welcome to the Inside Network. Welcome to this INDepth for the Inside Network. We're delighted to learn more about downside protection and also diversification with the co-founder and the director at Atlantic House Group, Andrew Lakeman. Andrew, welcome.
Hi, Laurence.
So let's start with diversification. You've got this challenge for advised clients, turbulent times that we're potentially moving through. What level of diversification should they be looking for, particularly to match the best in class in terms of asset allocations?
Over the years, lots of clients have got exposure to alternatives, and they've accessed that exposure through things like listed investment companies. And that often hasn't worked out so well, because even though the underlying asset might have done okay, ultimately you're in a vehicle that is just a share like anything else. And in times of stress, that can behave in a lot more volatile way than you might expect. And I think at the moment, although I've got no axe to grind with private equity, private credit, credit in general, but the bottom line is all those assets are bought on the premise that the economy will perform well. So they're just another way of getting exposure to equity. And so in the event of a downturn or inflation or a big interest rate rise or whatever nasty surprise, I think those things might not provide the diversification that clients maybe think that they are getting.
So let's explore this Uncorrelated Strategies Fund that you're bringing to market. It's got two core components. Could you explain what they are and what they're designed to do?
Yeah, sure. So if I just take it sort of back to front, there were two things our clients wanted. And again, this started in the UK, and I don't think it's any different anywhere else as we're exploring new markets like Australia. And the first thing was that investors have either expressed a desire to be long volatility, or investors have maybe less precisely asked for things that gave some form of downside protection. In other words, things that are going to go up when markets go down quite significantly, not small drawdowns, big drawdowns. And then the second thing that our clients have asked for are things that are genuinely diversifying, or to put it another way, non-correlated to equities. Because historically, obviously, equities and bonds work together, and bonds gave that diversification or lack of correlation with equities. So with that in mind, we built a portfolio, or we came up with a portfolio that had two core components. The first bit is a long volatility component, and we do that using two methods, which I'll come on to. And then, because most of the time this bit isn't going to work, and you hope it doesn't work, because you hope that the economy works out well, you hope the stock market goes up more often than it goes down. So ideally, you want something in a portfolio that's going to make a bit of money over cash most of the time, a modest return. So we populate this side of a fund with a number of strategies that we call diversifiers. And the name of the game there is that these things should make money in a year like last year.
So you've blended there the tail and trend, and that's an opportunity to offset the diversifiers. Could you talk about how blending that offers you something different?
Yeah.
What does that do in terms of the sorts of situations it will perform well in?
There's probably two ways I kind of think about that. In kind of option jargon, tail gives you exposure to a big spike in implied volatility. Trend, lots of people do buy trend funds, and they may or may not think of trend in this way, but trend captures realized volatility. And also with trend, it gives us the ability to use different assets like FX, like commodities, like rates. And typically most of our tail is exposed to S&P and VIX, but blending them together, we think, captures that downside nicely. There are markets or market situations where one works better than the other. I mean, in a massive event like a COVID or something like that, they're both quite similar, but in different markets, they can, as I said, complement each other quite nicely.
To achieve this strategy, you look at the quantitative investment strategy market. Could you tell us a little bit about it and how you try and navigate what's quite a large opportunity set?
Yeah, well, I mean, firstly, we're just trying to invest in whatever's the most suitable vehicle. So we can do direct derivatives, but operationally, some of the strategies that we have on, it would just take a lot of legwork, a lot of people time, and it's just a lot easier if you can outsource that, if you like, to a bank. A bit like an advisor might buy a fund rather than buy direct equities. And the QAS market, to give you a background, I mean, it's about 450 billion in size, or 400 billion in size, I think. There are lots of different indices that range from very simple, like mid-cap versus small-cap, value growth, to the more exotic and more complex, certainly things like tail-type strategies. And the idea there is really that banks have really, since the GFC, got quite serious at providing these strategies, as big institutions in particular have realised that it's a more efficient way in many situations than maybe buying a hedge fund. Back in the day, people might have used a hedge fund to do currency carry, FX carry. But now, if you know what you're doing, you could maybe buy one of these strategies. So it's a big market, it's a deep market, it's a liquid market. But for us, it's really a case of we're always looking for just the best way to do something, whether it's a strategy or something we can just do through the listed options market.
Let's bring it back to the advisor. They're sitting across from a client. This uncorrelated strategies fund, where does it sit in the portfolio? And what are you expecting it to do in terms of the role it's performing?
It's an incredibly easy thing to put in a portfolio because it's a straight alternative product. People throw around the liquid alternative tag, which I think resonates maybe more here than in the UK. But that's good as a label, because one thing it's liquid, daily dealing. Everything we buy is liquid, therefore the fund should have that same liquidity. So I guess in Australia it would go in the liquid alternative or alternative bucket. In terms of what to expect, hopefully you don't need it to perform and give that downside protection, because that would mean markets have behaved themselves. But if markets do come unstuck, it will make plenty of money for investors. And if markets are anything like last year, which were broadly good, the fund should tick along quite nicely and make a reasonable return over cash. And when it won't work, because it is important, I mean, one of our bugbears is, no one ever tells you when their product will not work, and everyone's always very bullish. But if markets just whipsaw around between sort of here, down 10, back, down 10, back, we won't do as well in that situation.
That's a beautifully rounded answer. And as you say, everyone paints the story of when they're successful.
They do indeed.
Very insightful. Thank you so much, Andrew Lakeman.
Thanks lots.